So what is a core and satellite portfolio? Basically, it's a portfolio made up of the majority of or the core of your investment in a passively managed mutual fund that tracks the market, such as the S&P 500. This core investment should have low volatility, high liquidity, and must have low management fees and trading costs. The rest of your investment goes into what are called satellites. A satellite is an additional strategic investment aimed at increasing the returns of the portfolio by allocating portions of it into riskier investments. To create a model core and satellite portfolio, I've chosen to allocate 50% of my investment into an index fund as my core investment. For the satellites, 10% will be put into a high bond yield fund, 20% into a biotech fund, and the remaining 20% into a healthcare fund. In order to test this strategy, we'll take a look at the past 5 years of historical returns for the mutual funds chosen. We'll then find the risk and return for each mutual fund individually and create the core and satellite investment model to measure its portfolio's risk and return. Finally, we'll compare the risk and return of each portfolio to find the optimal investment and test whether the core and satellite approach can effectively minimize costs and volatility while providing an opportunity to outperform the broad stock market as a whole. Here I've calculated the expected return and risk measured by standard deviation for each mutual fund. Using these measures to create the core and satellite investment model, I found the portfolio's return to be 20.09% for 16.08% risk. Next, I took the risk and return for each of the mutual funds and created an efficient frontier for the stocks chosen. The results of the test showed that the core and satellite portfolio did outperform the S&P 500, but for a much higher amount of risk. The better alternative would be to invest directly into DLHAX than into the core and satellite portfolio. However, the core and satellite portfolio is still able to produce a high return for much lower costs associated with it. Another way of testing the strategy was to perform a two-sample t-test assuming unequal variances. I found that the critical one-tailed t-value was much higher than the t-stat, indicating that the core and satellite portfolio has a high significance to outperform the market. Once again, my name is Rainwater, and thank you for watching my presentation.